if you want to eventually sell your business or walk away from your business and know that you can have a life without having to work in 18 hours a day, it has to have an infrastructure where other people can take on those tasks. But not only take on the task where you feel confident as a person that those people can actually deliver those tasks without you having to micromanage or stepping in and fixing problems. That is, that is a big gap. And that is where I see these 85% of businesses don't sell. Hi, and welcome to the Build and Exit podcast. I'm Julie Wilkinson, and I'm your host. I started the podcast off the back of the work I do in my company, Wilkinson Accounting Solutions, because I found there was a massive gap in the UK and across the world in terms of exit planning and business owners and founders scaling to maximise generational wealth. I'm a chartered management accountant by trade. I used to work in corporate businesses for about 20 years, running sort of multi-million companies and managing large-scale teams and mentoring. And I decided to start my company because I saw that I feel the actual accounting services in the UK is relatively poor, because there was a gap in knowledge and skills in terms of what sort of a traditional accounting and bookkeeper does versus what you would see sort of a strategic finance partner doing to actually scale businesses and help them on their track. Now, I think there's a knowledge gap for entrepreneurs in the SME world when you're looking especially around sort of the 3 million to 20 million mark in terms of knowing what a finance team can deliver. Unless people have come from a corporate background, I find entrepreneurs, they're not used to hierarchy of structure. And if you only know what you know. So I'm here to deliver the message of, why a finance team and sort of governance and controls is really crucial in that scaling and transitioning your business to an asset. So my mission is to help owners build generational wealth. And when I talk about generational wealth, what I'm finding is I've been involved in over 100 acquisitions now, and I speak to hundreds of founders and business owners either buying or selling. And in the UK specifically, only 75 to 85% of businesses 75 to 85% of businesses that go into market don't end up selling. And there is a reason for that. And those that do, the truth is at the minute it's a buyer's market. We know that there's estimated over 600,000 businesses that's going to be looking to exit over the baby boomer generation over the next 10 years. So obviously, with everything that's also going on in the UK with sort of millionaires leaving and tax changes, there's a big risk to the UK economy in terms of jobs going where founders are sort of closing shop because they can't sell. So if 85% of businesses that go into market don't sell, the interesting concept is when founders are starting and scaling, I speak to business owners in all different sizes. They often say, that'll never be me, I'll be okay. Yet if 85% of businesses aren't selling, in the end, they were those founders. So there's a gap in knowledge and I think sort of expectation of where businesses can go, because when you start businesses and we have entrepreneurial people, they're in the midst of running their businesses, but sometimes it's chasing the next sale and the infrastructure isn't getting set up in the background. So I wanted today's podcast is going to be around sort of financial controls and teams and how it's such a crucial aspect to scaling your business to actually create generational wealth. And generational wealth to me means that your business can carry on past you, because in the end, we're only on this earth for so long. No one knows how much time they've got. And the question is, are you building a legacy or are you building a job? If you're building a job, that's fine. There's nothing wrong with that. But in the end, a job stops. And at some point you might want to retire. And some people may go, well, I never want to retire. But then we know that, we don't always have a choice. We have ill health. And then at some point in life, you may come to the point where you can no longer run that business. And then you have to decide, but what do I want that business to do? So the first myth I want to, take on is that actually when we say exit in a business doesn't just mean a business owner has to sell their business. It is obviously an end form, and there's different ways that you can sell your business through to sort of generations of family, management buyouts, employee trusts, or obviously to third party buyers. But actually, a lot of business owners just want to have their freedom. And if you want to have your freedom in a business, which means you can choose to go on holiday for, maybe a month, 2 or 3 months at a time, then really you are part exiting your business. Because if you're not away for more than a week or a 2-week period, which is an average holiday, you're doing different to what, because nothing really necessarily will critically fall down in those periods of time. We're looking at, if you're away for a longer period of time, will the business critical tasks fall down, and could that significantly impact the risk of the business? And the truth is, the surveys that I've done, not many business owners, and we're looking at this 85% that don't sell, these are the business owners where if they stepped away for 3, forget the fact that they're selling, if they were 5 years earlier and they had said, I'm going to go and step away from my business, if they can't step away from their business and they're falling down, the truth is, when they go to market, is somebody going to actually want that business, especially at the value that you want as the seller? So this is like the fundamental problem, is it doesn't have to be a full exit immediately, because what we're saying is, what you're doing is you're slowly transitioning your business, and effectively it moves from a job over to an asset. An asset is something that generates money. So some people look at assets, things like, crypto, property, gold. All of those are assets, but then in reality, so is your business. Your business is just another form of asset that can generate income. The difference is we have to build those businesses from the ground up, unless we acquire, which is where acquisition comes in, because acquisitions is obviously a good route to acquire into something, or to obviously massively grow a business operations quickly. So therefore, it's still an asset. It can still generate money, but it's not quite the same as an independent asset that's just easier to buy and it runs. You have to sort of build those businesses. And I don't believe in the experience I have with business owners that many people are thinking that far ahead. There's a lot of pushback, well, you can't forecast and plan that far ahead. There's circumstances out of my control. The truth is, yes, you can't control the environment, but you can control how you deal with and how prepared you are for situations. And this is what we talk about controls. So controls is effectively risk mitigation. What's your biggest risk, and are you protected against it? So we go back and look at some of the big things that have happened, in the economy, like Brexit and COVID, and people go, it's not my fault, I didn't know it was going to happen. No. But what's actually happened is, forgetting the scenario, forgetting the fact that COVID happened and maybe your revenue dropped. If you had planned, what's my margin of safety? So a margin of safety is effectively, what's the lowest point that my business can cope without any sales? So forgetting COVID happened, if you had regularly looked at, where's my margin of safety? What can my business cope with? How long a cash would I have in the bank if these scenarios happened? The truth is, when COVID came, you would have been prepared. You may not have been able to stop it, and perhaps it may have gone below the threshold of what your margin of safety was, but you would have known. So where this happened in, the January, when the COVID started, those that were prepared would have probably known in 2 or 3 weeks. They would have known, I've planned for this. This is my situation. I've got to deal with it. Those that didn't plan were just frantic. Oh my God, my business is going to go down. I don't know what money I've got. I'm just not going to pay my taxes. And those that didn't prepare are typically the people that went and got the COVID and bounce back loans and are now in financial trouble because of that, because the people that were prepared knew what they could take, took what they took, but planned and managed that cash. People that wasn't prepared just took the money, spent it all, not necessarily on themselves, but on the business, but they didn't really plan. And they perhaps spent it on things that they shouldn't have spent it on, and they didn't really plan. And then they got into financial difficulty later down the line. So planning is a real part of risk mitigation. And I believe not everything's in our control, but everything can be thought about. And that would be part of your risk mitigation strategy. So your risk mitigation strategy is, because you have got risk that your turnover can drop without something like COVID. We see business demands change. How we're seeing the current with Trump putting the tariffs in the US, that could change a business model. That could have as severe impact on our business as essentially COVID coming in and hitting. Maybe not in sales drop, but in profit drops because of the cost. So, there's always going to be external influences that are impacting us, and we have to choose as entrepreneurs, who are we going to be? Are we going to be those people that plan, or are we going to be those people that just firefight on what's happening in the economy and letting that impact how we feel? So then we look at financial control. So risk mitigation, what's our biggest risk and how do we mitigate it? And then we look at, how does my business trade to mitigate those risks? So we have business, it is hard for businesses because we have ethical responsibilities and we have legal responsibilities. There are certain legal responsibilities in different industries. Obviously, different industries are more heavily legalized than others, which is normal. But obviously, we all have things in our different industries in our life where we have in our business where we have certain legal obligations. And sometimes that costs money. And you don't necessarily see the value at the top line in terms of the sales. So that would be something like, my business has reached the audit threshold. I now need to bring on an auditor to do my accounts. As business owners, I know, because I see them, we speak to them. They don't see any value in that. They're like, but why do I have to pay to have my accounts audited? I've had my accounts for years. The reason is you've grown to a level and you've now got a legal obligation to stakeholders, not just a moral obligation, not just an ethical responsibility anymore. And you have to, you're at a size of a business where you've got to be seen to actually that you're managing things correctly. And that's an area where people get into big financial difficulty. Well, not just financial difficult, but they can get into issues when they start going into those audit thresholds, because that's when third parties are starting to independently review how is your business trading financially, but also against sort of legal obligations and what are you reporting to stakeholders and things like that. So we look at financial controls, and then there's ethical responsibilities. Is just how do you want to trade ethically? Like, which suppliers are you using? Are you paying staff fairly? There's lots of things now in the world where we have a sort of social corporate responsibility. And I know business owners are really passionate about looking after staff or customers. So that's something that we're looking at. So we have these responsibilities, and then we obviously have to manage day-to-day trade, business growth, employees. And then as owners, we want to maximize our own wealth, that we don't start businesses for nothing. We're investors, we're investing our time, we're investing our cash, and we want to build something off the back of that. Whether you're acquiring or whether you're organically growing, you're doing a similar investment, you're just doing it in different ways. And you want something at the end of that. And in the end, that's really hard to get, because what I see happens, and this is where we come back to the 85% of that don't sell, is businesses are chasing growth. So it's sales. They employ people. They bring in a couple of contractors, and things are going really well. They're bringing on really good customers. And then bang, the owner starts to feel they were already busy and now things are completely out of control. The reason it's got out of control is because the sales have come in. They've brought employees in to do the doing. And when there was only one employee, it was easy to manage. That scaled to maybe 10, 12, 15, possibly even more. And actually, no infrastructure has been put in for those employees. So sometimes there's not even job specs, and sometimes there's not objective and basic things like that. Sometimes they are in place. But even when they are in place, are they actually delivering, or are people being moved into roles because other areas of the business isn't set up and things are just happening and everybody's firefighting? That's the typical situation. So the owner is now completely out of control, or feels out of control, because now they're still doing everything they were doing, which was meant to be relieved from the staff that they've brought in. But the staff don't do what they're meant to do. It doesn't necessarily mean the staff are all bad at their jobs, but they just have no control. They have no processes to follow. Now the owner's got all these people to manage, and they've got to deliver, and they've got higher customer demands because they've probably got bigger customers and more of them. And this is where we have to balance scale with infrastructure, with controls. Because when we think about the 85% that don't sell and they go to market and a third party buyer comes and assesses it, they're assessing what are the operations of this business. Although we value businesses on past financials, buyers are looking for the future. They're buying the future. What is this business going to bring me? And if as the seller, as the owner, that your life is hectic and you work 24, you're working 18, 20 hours a day and the staff don't perform, going to market is going to come out in due diligence. As financially you might be there, but if that financials is happening off the back of you being burnt out and working all these hours, you could be missing 2 large commercial roles, which could significantly drop your profits, and therefore the value drops. And that's why the valuations, and we talk about adjusted EBITDAs, where businesses are overvalued. Even if you're not manipulating your EBITDA and you're doing it fairly and you're going to market with the current position of the business financials, if those financials are overstated because you don't have the right infrastructure or the right investment in the business, then it's still an incorrect valuation. It's still overvalued, because operationally, commercially, the business isn't worth on paper what it is in reality, what you're showing it is on paper, because the person buying it doesn't want the hassle doesn't want the strain of the life that you've got running the business. So when we look at financial controls and we look at governance, what we're ultimately saying is we are changing the business so that business has a structure where, as the owner, you can relieve tasks to your staff and the staff actually performs. And what a lot of people don't know is finance plays a key role in that. Because in a corporate company, the CFO would actually run sort of corporate governance policies and oversee that type of thing. And the reason for that is most of these risks, most of these issues that happen ends up hitting the financial performance of the business. Because in the end, the biggest thing that will close the business is cash, and obviously lack of trade and low margins. And all of those things should be overseen by your finance team, because that's who provides the data in terms of your profit and loss, your management accounts, and your cash flow reports. And that is why it fits nicely into a finance role. But obviously, how do you get there? So a lot of people will get to a certain level and just go, I'm going to hire a CFO. Now, the reality is, you've got to start asking, what value does that CFO bring at that stage? Because a CFO is a strategic leadership team member that should sit on your board, that will strategically steer the direction of your business. But if you can't get any reports from your business because you don't have the right infrastructure, what benefit does the CFO bring? I've seen so many businesses, hundreds of businesses that have recruited really expensive CFOs, and the truth of the matter is they still can't even see basic management accounts. So it's like, well, what value? So I'm not suggesting that a CFO can never bring any value to a business, but I do think in the SME world, we have to start being realistic about, when does the CFO bring value? At what stage in the journey does it bring value? And then underlying that is financials are all based off the fact of how well the business is ran operationally. So finance is a back-end function which generally impacts from the operational cycle right from the front end. So this could be just things from, are costing right in your project system? Is your inventory managed right? Do people book in stock on systems? Do you have payment terms with suppliers to pay them on time? Do customers pay you? Now, all of these things end up getting reported in your management accounts. But if none of those things are in place in the front end, how do you ever report them? So, and then you have other operational things. So project systems, people have project systems in place. Nobody updates the project statuses. So customers don't get invoiced. Customers don't get invoiced. There's no age debt report. There's no cash that comes into the business. And I've seen businesses of sort of 10, 15 million, where when we do these investigations, we found hundreds of thousands of pounds not invoiced because nobody actually knew. Because there is one thing, somebody doing that process, but there's a second thing, is somebody's checking the work of the doer. So I call them doers and reviewers. So if you raise sales invoices, great, but who checks when a sales invoice hasn't been raised? And how do you actually know a sales invoice hasn't been raised? Now, this is where owners get out of control, because when the business is smaller and it was just them, they were in control of their invoicing. They invoiced themselves, they could keep control of it. Now the business has grown, there's lots of people involved in that process, they can no longer keep control. They're telling themselves they can keep control when they're doing it, and they feel, oh, I'm doing it, so I'm doing it right. But how are they doing it right? Because whenever we go in and investigate these things, actually they're not, they're still missing things. Now, that doesn't mean they're bad at their job, it just means that the business has grown to a level of size where it now needs different management. It needs a different type of reporting, it needs different types of systems, and it actually needs an infrastructure within the whole organization of how people behave and do their tasks, which is outside of KPIs. So there are KPIs, but KPIs are there to measure key statistics of a business that keep that business trading. Most people will only have 4 to 6 KPIs maximum. Outside of those KPIs, there's fundamental processes that also need reporting and data on them to make sure that people are delivering, because lots of processes make up one KPI. So lots of people are focused on fancy dashboards and KPIs and sales reporting, which is great. But underneath all of that, those KPIs are being delivered by a variety of tasks that multiple people are doing. And if those people aren't doing it right, even when you report on the KPIs, the question would be, are you reporting on them right? Because if, let's just say your KPI is to never have stock for more than 30 days. Well, if people have stock in the warehouse that they haven't receipted onto the system, your system might show you, I've got only got 30 days of stock, but is it the truth? Because have you got a load of stock somewhere sitting in a warehouse that's at risk because nobody's ever receipted it? So this is what we talk about financial controls and governance. So I'm really passionate about this topic because I know from working in big corporates all the way, I've worked with small SMEs all the way through to big corporates, and it is the thing that fundamentally changes the business infrastructure, and it does change owner's life. Because if you want to eventually sell your business or walk away from your business and know that you can have a life without having to work in at 18 hours a day, it has to have an infrastructure where other people can take on those tasks. But not only take on the task, where you feel confident as a person that those people can actually deliver those tasks without you having to micromanage or stepping in and fixing problems. That is, that is a big gap. And that is where I see these 85% of businesses don't sell because they go to market with an expectation of value because they've taken so much money from the business. Yet a third party that wants to take the same amount of money from the business and pay you as the owner, that isn't possible because there isn't enough margin in your business to account for the investor. And that usually means that business models need to be at least 10% higher margins, and they're typically traded at a smaller level to account for all of the real costs that you need. So you can run a business, make more money and not work in the business. That is absolutely possible, but that needs planning, it needs investment, and it needs a different mindset. It needs not a owner operator mindset. It needs more of a strategic investor mindset. And the owner has to be prepared to go on that journey to move from owner operator to sort of silent investor, which is effectively how the business becomes an asset. So my leaving notes to all of this is how I started. There's over 600,000 businesses that are going to come to market over the next 10 years or close by voluntary liquidation or sell to big PE firms. The word is PE firms are going to get a load of sales. They're going to be in the firing line to buy these businesses because they're the ones that are going to have the cash to be able to cope with these businesses that aren't performing. And I feel it's at real risk. And we need to start transitioning our mindsets as owners. Is how can we continue to keep our wealth and our business without us having to work 18, 20 hours a day? And because it will benefit you, because in the end, you may actually think, I don't need to sell yet, because why would you sell something that's generating you money? People tend to want to sell either because they're at an age where they just want to retire and forget about it, or more often than not, they're just completely deflated and exhausted and they just need out. Well, if you're at that point and you're trying to sell, before you even go to market, you've got to think, well, if I'm feeling like this, why would someone want it? Because it's not just going to suddenly change when somebody takes it. Somebody's going to have to make it change. But that person can be you. As the seller, you can change those things with the right help and the right guidance. So if anybody wants to reach out for me, I'm Julie Wilkinson, Profit Queen on LinkedIn, and all of my contact details and my company's Wilkinson Accounting Solutions. But I really want to thank everybody for all the support on the podcast. More will be coming soon. And if there's any topics that you want to cover, drop me a message either on YouTube or the channels, and I look forward to seeing you again soon.